Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. In this episode, we focus on the rise of retail traders. And this is, in fact, one of the biggest stories in the markets over the past year. Coronavirus lockdowns, commission-free and easy trading on apps, and some extra money from stimulus have led to a surge in retail trading. Retail trading accounted for 23% of total U.S. equity trading in 2021. That is according to the Financial Times. And retail traders have shown the ability to move stocks at times. So that is why many institutional investors now want to follow their trades and use in their own trading models. And we have two excellent guests today. My first guest is Jamie Weiss, founder of Buzz Holdings, who created the index for the VanEck Vector's social sentiment ETF, ticker symbol Buzz. And this ETF, it launched earlier this month. It was promoted by Dave Portnoy, and it has become one of the most successful ETF launches ever. In the second part, I'll be joined by Matthew Tuttle, CEO of Tuttle Capital Management. They have filed for a new fear of missing out Fomo Etf that will target everything from stocks, from developing emerging markets to SPACs, ETFs, derivatives, volatility products, and both inverse and leverage funds. So let's chat with Jamie Weiss now. Jamie, welcome. Great to have you on the show.
Thanks so much for having me. Great to be here.
Tell us a little bit about your background to start off.
Sure. I've been involved in financial markets and investing my entire career. My background generally is equity derivatives, and I've always had a keen interest in how investor sentiment actually plays itself out with respect to price discovery and stock prices. And part of that journey in my career led to the creation of the Buzz Index and the research before that. And that's going back 6 or 7 years now, but I've been I'm dating myself, 25 plus years maybe in the business.
Great. So you're not new to the ETF world, and your index, as you mentioned, it has been around for 6-7 years. So we saw the launch of the Sprott Buzz Social Media Insights ETF, ticker symbol BUZ, that launched in 2016. It tracked your index, but it closed in 2019 because it was not able to gather assets. It had less than 10 million in assets after 3 years. So tell us what has changed between Buzz and the new ETF, the VanEck Vector's Social Media Sentiment ETF, ticker symbol BUZZ. What has changed in these 5-6 years?
Well, from an index perspective, nothing has changed. We have been running this index live since December of 2015. As you mentioned, the index was tracked in a previous ETF for a number of years. But the index has not changed. The calculation methodology, even when the first ETF closed down, we kept the index alive. And that's because, looking back now, we were clearly a little bit early in our view of, the power of the many millions of people who are online on social platforms talking about stocks and talking about their investments, and the importance of that relative to, the views of the broader investment community. I think catching up to that and understanding now better than ever today, just how many people are, talking about their investment portfolios, the independent lens and the sort of the freedom of research that they have that's really differentiated from, traditional Wall Street analysts, and collectively, the voice of that community and the impact they can have on the stock market. So from a timing perspective, especially what's happened recently, coincidentally, I'd say, in the past few months with Reddit being in the news, people are very aware now of the power of social media, that financial related discussion is an important part of that. landscape and are very interested in the insights that our index has been tracking for the last 5 years. And of course, it's great for us because this is not anything new for us, and this is something that we can point to a long track record of following these, collective insights and showing how they actually can not only provide some interesting insight in security selection, but more importantly, outperform traditional investment styles.
Yeah, definitely. Individual investors now have access to a lot of information and resources which are needed to make better investment decisions. And that was certainly not the case 5 years back. So tell us a little bit about the index. How exactly does it work? And it is the BUS NextGen AI US Sentiment Leaders Index. Quite a
Sure,
name.
happy to. Yeah, it's a mouthful. We'll talk a little bit about the index construction methodology. I think that's important because, especially with what's happened recently in the news, and we see, these stocks moving very quickly, BUS was never constructed with the idea of short-termism. Certainly, there is, much more volatility around short-term sentiment to longer term sentiment momentum trading. And that's what we're capturing in BUS. And so when we think about stocks that could be eligible for the BUS index, there's a multi-step process that happens before the index is finalized and rebalanced each month. And it starts on a quarterly basis where we look at, first and foremost, only stocks that have market capitalizations in excess of $5 billion. So we're looking for large cap US equities. And depending on the quarter, there's usually 1,000 or 1,500 of them that meet that size threshold. And the second test that we do also on a quarterly basis, and this is an important test, is of those 1,000 to 1,500 stocks, we look at the type of conversation that's happening within them. And we're not measuring sentiment yet, but what we're looking for are stocks that exhibit a high degree of breadth and diversity, and importantly, consistency within the conversation. So we're identifying stocks that are being discussed across online platforms day in, day out, regardless of the news flow, regardless of, an earnings release or some corporate event that might be happening. We're really looking for that consistency of conversation, and we measure that over the past year. So essentially, we're looking for stocks that have seasoned conversation and that have a seasoned market cap of $5 billion. And that usually results in a list of eligible stocks between 250 and 350. And we'll set that eligible universe in place for the quarter, meaning that each of the 3 monthly rebalances that follow will only source stocks from that eligible universe. Then what happens when we come time to a monthly rebalance, we look at the eligible universe and we do another 2 tests. The first is, are the stocks in the eligible universe still above $5 billion? And to the extent they are, they continue to be eligible. And then we start thinking about sentiment, and we look from the period of the last rebalance date to the current rebalance date, what is the aggregate collective sentiment around each of those 250 to 350 stocks? And we can essentially sort and rank that list of stocks from most positive to least, with the top 75 stocks featured in the index for that rebalance date and weighted according to their relative sentiment strength. So the higher the sentiment level of the stock, the higher the weighting in the index. And all we do is cap that weight at 3%. And that ensures that the index remains diverse and no individual stock will have an overweight within or an overweight impact on the return stream of the sentiment index.
Very interesting. So basically, the index tries to eliminate anything with very short-term or short-lived hype and focus on the true buzz, which has been consistent and which has stocks which have been displaying positive sentiment for a long time, for many weeks, many months.
Yeah, it's a measure of that longer-term sentiment. It's not about the current hype stock or a current meme stock. It's not going to try and quickly rebalance its holdings to take advantage of that. When we started the index, Wall Street bets and the name or the concept of a meme stock didn't even exist. What we're trying to present in the index and allow for individuals to access and invest in is broad-based large cap US equity sentiment, and presenting the index to them as sort of the benchmark measurement of broad large cap US investor sentiment that is sustainable and not subject to short-term swings or certain one-day hype kind of environments.
And I see that GameStop is not included in the index. And this stock is actually the poster child for the power of the retail army. But you mentioned some size thresholds. So is that the reason that it was not eligible to be included in the index at the last rebalancing?
Yeah, exactly right. So back on January 1st, we would have set the eligible universe for the first quarter of 2021. And on January 1st, GameStop did not have a market cap of $5 billion, thus making it ineligible for the next three rebalances. And that sort of slowing down process or safeguards within the index is, again, very important to us. Certainly, GameStop became a poster child for individual investor activism, we'll call it, within an individual name. But as we look to today and we look back at how GameStop was discussed in January, it's really quite different and interesting. So first of all, the conversation in January had nothing to do with valuation or really the business prospects of GameStop, but it's quite different today. And that's the seasoning that I referred to, where today, yesterday GameStop released earnings. They've had a lot of management turnover. There's a shift of focus of the company. The conversation that dominates GameStop today, especially outside of those, Reddit channels, is really one focused on valuation. Is GameStop going to be able to turn around its business? They have $6 or $7 billion a year in annual sales, and the company is valued at 10 or 11 billion now. That's far from, the most overvalued company on a price to sales basis. I think the last time I looked at it, it was around 190th in terms of that rank on the list. So it's really a conversation now about value. To the extent GameStop on April 1st maintains this market cap and allows it to be seasoned, it will be eligible to get into the Buzz Index. And then we'll just have to see what the sentiment of the conversation is come the next rebalance dates.
And does the index also short stocks with negative buzz, or in the future will it short stocks with negative buzz?
Nope, the index is fully invested and long only. And so it really serves as an alternative method of gaining exposure to large cap US equity. So to the extent that large cap equity exposure should hold a place in someone's portfolio, they have choices about how to get that exposure, and it can be market cap weighted like the S&P 500. It could be very specific to a certain factor like value or growth, or a certain sector like technology or healthcare. Or you can now own a collection of large cap US equities based on their sentiment readings. And very much we believe that sentiment is essentially a factor no different than all other ones and has always been a factor. The difference today is that we can measure it, right? We never had the tools or the ability or the data to measure sentiment. It was always something that was either observed by people in some kind of polling or proxy manner, where you would look to a consumer poll or you would look to market-related proxies like the VIX, and people would try and think about overall macro sentiment with the markets, and often through the lens of it being contrarian. What we can do now using data is very specifically talk about the difference between sentiment with respect to IBM or Ford or GE or Tesla or you name it, Exxon. And so that is really what's changed, where we can now identify different sentiment readings for different individual stocks, and you can have large cap US equity exposure based on sentiment strength.
So I was interested in learning a little bit more about how the AI actually measures this sentiment. Does it look at tweets, memes, emojis, blog posts, or everything?
Yeah, so the AI, or really it's a subset of AI, which is natural language processing. And the way those models work today have really significantly advanced relative to 10 or 20 years ago. The early days of natural language processing, you could basically train a model from a dictionary, and you would have certain words that would associate as positive words or negative words, and then a model would essentially search for those words and then be able to tell you if it's positive or negative. But you can imagine all the limitations of that approach especially with sarcasm and stock-specific conversation. People talk very differently about stocks, use very different words when compared to if they're talking about their social lives or a product or a brand that they're interacting with. Today's natural language processing works very much like our minds work, right? It's trained with experience. And to train a model to understand conversations with respect to stocks and finance, you need to be able to teach that model or train it with millions of examples of posts, people talking about stocks that have been correctly labeled as either being positive or negative with respect to that stock. And that's millions and millions of examples that a model will need to be properly trained. But once you can accomplish that, the model can then see new posts, new text, and understand whether those texts are positive or negative based on the experience it has. So very similar to you and I, we've been in finance for a long time. You can go onto StockTwits, you can go onto Twitter, you understand the language that people use around stocks, and you can read a post and very quickly understand if that person is positive or negative about the stock. The same goes for natural language processing models. They're essentially trained and taught to understand stock conversations the way you and I understand them. The second part of your question was very good too, because that conversation in language, and specifically, more recently, the use of emojis has increased dramatically in the conversation. So 5 years ago when we started, hardly anyone in stock-related conversation used emojis, but many people in their social lives used emojis. Well, now there's so many more people talking about stocks, and the volume is so much greater, and the use of emojis is a natural part of the conversation, whether it be stock-specific emojis like rocket ships or bears. The model needs to understand that. And so we continually retrain the models and teach them with new examples of posts that would include emojis so that the model can really understand what those emojis mean in the context of the conversation and accurately label the posts as being positive, neutral, or negative.
Very interesting. So a few weeks back, Ryan Cohen, who is a board member of Gamestop and co-founder of Chewy, he had tweeted a photo of an ice cream cone, and which was accompanied by a frog emoji. So how does the model decode such emojis? I was just interested because the stock had rallied after that post.
Well, I don't know that specific post, but to the extent there's enough people that use ice cream cones and frogs in certain contexts, the model will understand that and be able to score it appropriately.
Okay, so you mentioned investor sentiment being a contrarian indicator earlier, and that is usually in the context of the broader stock market. If investors are just too bullish, then maybe it is time to take some money, some profits from your stock holdings. So is it possible that in case of individual stocks too, they generate a lot of buzz when they are close to peaking out?
I think that's a bit of a misconception, but that's essentially what we set out to prove or discover when we launched the Buzz Index back in 2015. We wanted to know if we can now measure sentiment at the individual stock level, and we can represent it in an index in a rules-based, systematic way, will that index outperform or underperform the broader market? Essentially, is sentiment a contrarian indicator? And what we found is it is certainly not a contrarian indicator. In fact, the Buzz Index has outperformed, the S&P 500 since launch last year, this year. And so really, I think sentiment is this, there's sort of the way we think about it from these longer term, we're not getting whipsawed by day-to-day sentiment. We're thinking about it almost month to month. I think those sentiment trends certainly have momentum behind them, not necessarily price momentum. It's not all price momentum securities in Buzz. There's a lot of value stocks in there as well. But when we can measure sentiment accurately, it sort of reflects the sentiment momentum, and that can carry forward for periods of weeks or months. And then, of course, the index is dynamic enough that it can rebalance itself, and to the extent that potentially value stocks are now viewed more positively than technology stocks, there's nothing stopping the index from rotating that sector exposure into those names. And the outperformance of the index, I think, speaks for itself, and hopefully finally puts an end to this idea of sentiment being some type of contrarian signal.
Another question which I was interested in is that does the model take into account posts by influencers, say a tweet by Elon Musk, which will have a lot more impact than a post or a tweet by regular folks like us?
Well, the model is a democracy. So no, we do not overweight the importance of a tweet from any one individual or any one platform for that matter. What we've really found over time is, yes, an Elon Musk or a person of influence, in the very short term, their post might have some impact on the stock. Typically, the more they post about stocks, there's diminishing returns of that impact. But more importantly, their posts spark a much broader conversation, right? So if it's Elon Musk talking about Tesla or, the former president talking about any one stock, what you find happening online is many thousands of people now engage with that post and provide their own opinions. And some may agree and some may disagree. And it's the collective insight that Buzz is always interested in, not the insight of one individual. There is no perfect expert who can predict and move stocks all the time. But the collective insights from the community and the reactions to that influencer's post just provide more data for our algorithms to understand and measure and really identify the true sentiment from the community's perspective behind that specific stock.
Excellent. Makes a lot of sense. Another concern which some investors may have is the potential for the index to be skewed by bad actors, spams, bots, which may try to pump and dump stocks. Is that a possibility?
Anything's possible, but it doesn't typically happen. And certainly the safeguards that we have around the index construction process prevent that. And I'll explain why. The first safeguard around the process would be the $5 billion market cap minimum. Just like in the olden days, and I'm a little older than the audience maybe, those old pump and dump call center rooms, right, where those bad actors would try to influence stock prices, they're almost always focused on very small, thinly traded companies, right? The small micro cap companies with small floats. And the reason that is because their activities have the potential to actually move the stock. It's very difficult for, a bad actor, whether it be, an army of human beings or an army of bots, to influence the price of Disney. It's just going to be very difficult. The company is too big to move. And so bad actors typically will focus their efforts on those small cap stocks and not the large cap stocks. The second is that the spam detection or the bot detection filters are quite robust, and they're robust on multiple layers. The first is, if you think of the social platforms themselves, think of a StockTwits. The last thing that StockTwits wants is an army of bots going onto their platform and ruining the user experience for their clients. And so they will invest quite heavily in their own spam filters to prevent those bots from infiltrating the conversation. And we use similar types of filters in Buzz where we can identify, suspicious posting activity. The second is we have a long history of doing this. So we know, using Disney as an example again, we know typically how many people are talking about Disney. We know there's growth in that conversation, but we know what the conversation generally looks like and how many posts are common for a certain day. It would be very easy to identify bots in the environment where you come in one day and all of a sudden the model has found there's 1 million new, quote, people or bots talking about Disney. They're all posting, the same sentiment. They're all posting similar types of things. It would be easily screened and found and flagged. And frankly, in 5 years, we've never had that situation arise because, again, the bad actors, the people that want to try and influence stock prices, they're not going to traffic in the large cap US equity space. They're going to stick around in those small stocks that maybe they can influence people to actually have an impact on the stock price.
Good stuff. Now, let's talk about some of the holdings in the ETF now. And I'm looking at the top holdings, and it's a very interesting, very diverse group of stocks, both, growth-oriented stocks, which benefited from coronavirus-driven trends, and also reopening stocks. Novavax, which is a vaccine stock, is the top holding as of now. Then I see Apple, Amazon, DraftKings, AMD, Disney, Boeing, and then Tesla and Square. Talk a little bit about these top holdings and also tell us how the buzz has shifted in recent weeks. Did you see a lot of change in the past few weeks during rebalancing?
Yeah, this is the most important thing I think that we can talk about today. It's really about understanding the holdings in Buzz. And, when you think about why people talk positively about a stock, and again, these conversations historically happened at dinner tables and with investment advisors or at a water cooler. Now they just happen at scale in an online sense. People are positive about stocks for really two fundamental reasons. One would be it's a growth equity story, and they believe the growth prospects of the company will continue. Or two, it's value, right? A stock represents value. It's mispriced relative to its peers. It's fallen too far for whatever reason. There was an overreaction to an earnings event or other news. So there's that value lens and that growth lens, and the dynamic nature of Buzz allows it to, when focusing on the top sentiment names, pick up from those different disciplines. And so you do really see a blend of, growth names and value names in the index. And certainly when we went through the rebalance a year ago coming out of COVID, we saw a big shift in the index, probably the most active rebalance ever, as names like Carnival Cruise Line, which weren't in the index but had fallen 80% in a month, became holdings in the index, and then subsequent to that, top performers. And if you look back at the top performing names in Buzz last year, you'll see names like Square and you'll see names like Carnival Cruise, right? And so that always is, to me, the most interesting feature or benefit that you can get out of the index, where you're not constrained to a specific investing style or a specific sector. The contributors to return can come from really just the best ideas from the community. I look at 2021, the top stocks contributing to performance. I see Plug Power as the first one, followed by two healthcare companies, Novavax and Moderna, and then American Airlines, and then Twitter. Those are the top 5 contributors to Buzz performance so far in 2021. And what a unique blend of securities. And go find another long-only equity manager or even hedge fund manager who can have as wide a lens and a diverse approach to markets such that those types of securities could all be in their top contributors to performance. If we think about it more recently, how did it, we just went through a rebalance last week, and what were some of the names changing? It wasn't a significant at all rebalance in terms of, what we saw in March of 2020 coming out of COVID, or April really of 2020. This month featured 11 names coming out of the index and 11 names coming in. And I would say at the margin, it's tilting now a little bit towards, old economy and value. But it wasn't, you won't find all 75 names changing month over month. It takes longer for these sentiment trends to play out. But what we saw coming out last month was ON Semiconductor, Intel, BlackRock, Visa, IBM. Those were the top names that left. And what were the top names that came in? Costco, Marathon Oil, Micron, The Trade Desk, Target, and Occidental Petroleum. So we have 2 oil companies, Target and Costco, 2 old school retailers, coming into the index and replacing some tech exposure. And I think, that's part of that slow shift, and we'll see what happens in the months ahead if this trend continues, if it's shorter term. But certainly, individuals online in the broad communities are identifying some of these themes, and we can react to it in sort of near real time.
Very interesting. Now, your ETF launched just about 2 weeks back, and it has already gathered more than 400 million in assets. So it's one of the most successful launches ever. And one of the reasons why it has been so successful is that it was promoted by Dave Portnoy, Barstool Sports founder. And Dave has more than 2.4 million Twitter followers. Many retail traders follow his trades. So tell us a little bit about working with Dave, and what role does he have in the index at all?
Yeah, well, Dave is, part of the ownership group of Buzz Holdings. And so he is, very invested in the process that we follow with, how the index works, and the power of internet, the power of the intelligence of all of these individuals, especially when put together, and is very much a believer in that long-term vision. On a day-to-day basis, of course, when it comes to the index, Dave has a lot going on. So the index construction process, the modeling, the index committee, that's all Buzz. And Dave will find out about the names coming in and out of the index the same time that everyone else in the world will. So there's no sort of influence or access to data outside of the same way that everyone else will consume it. What Dave really brings for Buzz, not only acting as a spokesman but sort of validating our approach, it's similar to what I mentioned before. It's not that Dave says to do something as a person of influence and everyone follows. It's more that, he sparks that conversation, right? And Dave doesn't just talk about Buzz, as he's been talking about stocks for a year now and talks about a wide variety of large cap US equities and sparks a greater conversation. And we can see that in the data. We can see that, before COVID, the number of messages that our models were processing on a monthly basis were around 5 million posts a month. Post-COVID, that conversation elevated to, on average, 10 million posts a month. And if we look at the last couple of months, it's actually exceeded 20 million. So, having these people act as, ambassadors for individual investors to empower themselves, to join online platforms, to start talking about their investment portfolios, to see, other people's opinions and make their own investment decisions. That's really what this is all about, and more people are doing it, and the collective insights from all those people, that's what we find in Buzz.
All great points. Congratulations on the successful launch, and thanks for joining us.
Well, thanks so much for having me. I enjoyed the discussion.
So that was Jamie Weiss, and I'll now be joined by Matthew Tuttle, and we'll talk about the Fomo ETF. Matthew, welcome. Great to have you on the show.
Thank you for having me.
So tell us a little bit about your background and Tuttle Capital Management.
Sure. So I got an MBA in finance in the mid-90s and went to work in middle market fixed income sales, then went to a couple of different brokerage firms, some insurance companies. In 2003, formed my own wealth management firm called Tuttle Wealth Management. In 2008, we were investing in a whole bunch of mutual funds that had pitched themselves as absolute return and ended up not losing as much as the market did by any means in 2008, but certainly more than I would have expected when someone's telling me absolute return. So kind of came to the conclusion the only way to do it right is do it yourself. So we put together our own investment strategies. In 2012, we started having other advisors coming to us and saying, hey, can you manage money for us as well? And then we realized a few years in that it was just going to be a whole lot more efficient if we did that in ETF format. So we started launching ETFs, and here we are today.
So let's talk about FOMO now. Your company filed for the fear of missing out, or FOMO ETF, recently. So why FOMO now? Tell us the story behind FOMO.
Yeah, and why FOMO now is because we need FOMO now. So this is the most interesting, for lack of a better word, time that I've seen in markets since I've been involved. You've got so much stuff going on where it's either, the social media, Reddit stuff with, Gamestop and AMC and, all of that stuff. You've got the innovative technology, electric vehicles, 5G, so on and so forth. You've got SPACs. You've got the constant battle between reopening stocks and stay-at-home stocks. And you've got the fact that there isn't a market anymore. It used to be if you said to me, hey, Matt, what did the market do today? I wouldn't have to ask you what you meant. It wouldn't matter whether it was the Dow, it was the NASDAQ, it was the S&P, small caps. I could either say, hey, it's up or down. Now, if you ask me, hey, Matt, what did the market do today? I got to ask you which one. I mean, looking at it as we're recording this, the S&P's down, the NASDAQ's down, and the Dow's still doing all right. So it's so confusing now for the individual investor. What do you do? And every single day is different. So what FOMO is designed to do is to, really simplify it for the individual investor, give them back control where they don't have to decide, hey, where do I need to be? How can I take advantage of this stuff that's going on without getting crushed? And that's what FOMO is designed to do. It's designed to be able to say, hey, this is the area, or these are the areas to be in. These are the stocks in those areas to be in. This is how much we should be in. And we've got a systematic approach for all of that.
Very interesting. And you are right. Every day is different now. We have seen this continuous rotation from growth into value and then again value into growth. So it's definitely a very interesting market and very interesting filing too. So the ETF is, or the index, not the index, it's an actively managed ETF. The model is designed to reflect current or emerging trends. And how exactly do you measure these current or emerging trends?
So what we do is we start off with a number of different universes. So we've got, say, a universe of SPACs. We've got a universe of stocks that are popular with retail investors. We've got a universe of stocks that are popular on social media. We've got a universe of innovative, technology types of stocks. And then we take those universes and put them into our quantitative models. And our quantitative models are either trend following or counter trend following. And what I mean by that is the way that markets work is you've got over the intermediate term and the longer term, you have trends. Objects in motion tend to stay in motion. If electronic vehicle stocks are strong, they tend to stay strong. If financials are strong, they tend to stay strong. So our trend following models are looking to capture those intermediate term and long-term trends. Over the short term, markets work a little bit differently, where something will go up too far, too fast, and it'll sell off till it gets to some sort of equilibrium, and then it can go back up again. So our counter trend models are designed to take advantage of those shorter term counter trends, where instead of our trend following models where we're looking to buy whatever is the strongest, our counter trend models we're looking to buy what's the weakest over the short term. And what we find is that having both of those types of models really smooths out the returns. And, and especially if you've got like a market like we're in right now, the counter trend models are going to be the most advantageous because every day is seemingly the opposite of the day before it. Where, you could ask me, hey, Matt, and pick a market, what's the NASDAQ going to do today? It's going to be up. Why is it going to be up? Because it was down yesterday. And, you can almost kind of count on something like that. So that's where the counter trend models come in.
So how much would be trend following and how much would be counter trend following?
We make it 50-50. So I'm not trying to predict, hey, is this going to be a trending market or is this going to be a counter trending market? So we're going to want it to be 50% of each. Both of those types of models, are going to work fine in the same market. They're not going to cancel each other out. But, certainly in trending markets, the trend following models are going to do better. And in a choppy market, the counter trend models are going to do better.
Yeah, counter trend is definitely a very interesting part of the model because we have seen these reversions to the mean very often. Now, focusing on the trend following part, so some investors may be worried that the fear of missing out may lead to trends or securities that are close to peaking out when easy money has already been made. So why should investors chase those stocks or trends in the fear of missing out on them?
So, and it's a great point. There's a couple of things. First off, we're going to typically have between 75 and 100 holdings. And we're also going to weight those holdings by volatility. So what we're trying to do is yes, we're trying to participate in these trends, but we're trying to do it in the safest way possible. Out of those 75 to 100 stocks we hold, is it possible that some of them are going to have peaked out? Definitely. But that's why we're diversified to the extent we're diversified. So that's built into the equation. We know that's going to happen, but that's going to be more than offset by some of the emerging things we're getting into, being able to use the counter trend models to take advantage of choppy markets. And maybe you're buying something that was strong and just went down way too much, and you're getting it at a much better price. So we're going to offset that.
Okay, another concern which investors may have is that why should they follow these hot trends instead of just focusing on fundamental analysis for selection of stocks or other securities? So do you see a small place for this ETF or such ETFs in the portfolio, whereas the core portfolio, say the retirement portfolio or the buy and hold part of the portfolio, should use fundamental analysis for selection of stocks and other investments?
So yes, but. So where we really see FOMO, we believe that the best way to construct a portfolio is to take what we would call a core and satellite approach. The core of your portfolio should be, something that what you can expect from it. And we believe that should be some sort of defensive equity. So, something that is participating on the upside, where you're getting anywhere from, let's say 70 to 110% of the market's upside, but is not going to participate fully on the downside. And that's the core of your portfolio. So you all right, that's the part I know what to expect. Where FOMO fits in is the satellite part. All right, I've got my core taken care of, and that's, 60, 70, maybe 80% of the portfolio. And it's somewhat defensive. So if the market goes down 30%, I'm not going to go down 30%. And now I'm using FOMO to get excess returns. I would not be using fundamental analysis in this type of market. There are so many interesting and different things going on in this market that I don't think are going away. So I'd be very careful with fundamental analysis, but certainly, I don't think FOMO should be 80% of your portfolio.
Makes sense. Now, let's talk about what the model holds currently. What are the current trends and counter trends suggesting?
Yeah, and it may not be necessarily what you think. I mean, so right now, the top holding is Johnson & Johnson. Second holding is United Health. Altria is third, Allstate, Equivia Holdings, Amtech, Realty Income, Stryker, Medtronic. So, I mean, it really has shifted out of a lot of the high-flying kind of technology names into more value types of names. And, and that's a shift that's happened over the past couple of weeks. And that's what the portfolio is designed to do as, value stocks and, financials, energy, industrials have become more prevalent. We're starting to shift there. There's always going to be a big chunk of, well, not always. You never know what the future holds. But historically, there's always been a big chunk of technology. But, now there is a definite shift towards value.
Definitely very interesting. I had not expected to see those stocks in the model. So this ETF will be rebalancing every week, correct?
Correct.
Should investors expect a very high portfolio turnover?
Investors should expect a very high portfolio turnover. No way around it. These markets, again, are so fast moving today that I don't know how you get away with some of this stuff that rebalances, once a year, twice a year, 4 times a year, and really even monthly. I mean, by the time you're actually doing something, whatever you're looking at could be obsolete already. We'd go down to intraday if we thought it would add value, but really weekly we found is kind of that sweet spot.
Now, you also filed for a fat tail risk ETF. Tell us a little bit about that.
So the fat tail risk ETF is designed to be a positive carry tail risk ETF. And what I mean by that is it's designed when the market's going up to make money. Not a lot of money, but some money. And then what it's really for is when the market goes down, and I don't mean, hey, it was down 2% today or something like that. It's for a COVID crisis where the market's down 33%, or 2008 where the market's down 60%. And it's designed to make as much on the upside as the market makes on the downside. So the idea is that you can put it in a portfolio and replace where maybe historically you put bonds. Because, I don't know if people have seen what's going on with the bond market lately. I would not have bonds as the risk reduction component of my portfolio. So it can go in where you would have put bonds. And, and if the market keeps chugging up, you don't really have to worry about it. It'll make money. It's not going to make a lot of money. If the market's up 30 and fat T is up 5, that's a home run. I'm a happy guy. But what is, hey, if we have another, COVID type of crisis, or, maybe the next one's inflation, maybe it's interest rates, maybe it's something we hadn't thought of before, then it's designed to try to make as much on the downside or as much on the upside as the market's down.
Interesting stuff. So these ETFs, they are expected to launch in May, I understand?
That is what we hope.
Okay.
So we're hoping for mid-May. You never really know, but that's what we're on schedule for right now.
Okay, both very interesting filings. Good luck with the launch, and hope to talk to you later this year.
Sounds good to me.
Thanks for joining us.
All right, thank you.
Thanks for listening. If you want to learn more about these ETFs and many other ETFs, please visit Sachs.com. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@Sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.